There is a wall of roughly $2 trillion in commercial property loans coming due over just 3 years. Most of it was borrowed when money was almost free, and now it has to be paid back in a world where it is not. To see how this happened, rewind to the era of near-zero interest rates. Developers and investors borrowed enormous sums against office towers, shopping centers, and apartment blocks, usually on loans that did not fully pay down. Instead, they were structured to be refinanced. You pay interest for 5 or 10 years, and at the end you take out a new loan to replace the old one. As long as rates stay low and buildings hold their value, the music never stops. The whole model quietly assumes that when the loan matures, a fresh loan will always be waiting. That assumption is the crack that everything else runs through. Now the loans are maturing. By the end of 2025, about $950 billion of commercial mortgages had already come due, with another $539 billion in 2026 and $550 billion in 2027. Stack those together and you get more than $2 trillion of debt that all needs refinancing in a narrow window. The industry calls it the maturity wall. And crucially, the problem is not that borrowers stopped making their monthly payments. Many of these buildings are still collecting rent and covering their interest just fine. The problem hits at the finish line when the old loan comes due and a new one has to replace it. Refinancing a building depends on two things: the interest rate and the building's value. Both moved the wrong way at once. Rates jumped, so a loan that cost 3 or 4% now costs 7 or 8, which can more than double the annual interest bill. At the same time, values fell, especially for offices, because far fewer companies need as much space as they did before remote work. A lender will only refinance a fraction of what a building is worth. So if the building is worth less and the new loan is more expensive, the owner suddenly cannot borrow enough to pay off the old loan, even though nothing is wrong with the day-to-day cash flow. This is called a maturity default, and it is a completely different animal from missing a payment. Offices are the epicenter. At the start of 2026, the national office vacancy rate was about 18%, nearly 1 in 5 desks empty, and delinquency on office loans bundled into bonds hit an all-time high above 12%. The numbers on already matured office loans are staggering. Among office loans that came due before 2026 and still have a balance, more than 80% are delinquent, and over 90% have been handed to special servicers, the workout teams that deal with troubled loans. Close to $25 billion of these bundled loans are simply sitting past their due date, not repaid, not extended, not resolved. They are in limbo, waiting for a buyer or a rescue that may not arrive. Here is where it stops being a real estate story and becomes a banking one. The United States carries almost $5 trillion of commercial real estate debt. Banks hold roughly a third of it, and a large share of that sits on the books of small and regional banks, the same banks that lend to local businesses and issue a big chunk of the country's everyday credit. When a building owner cannot refinance and hands back the keys, the bank is left holding a loan worth more than the property behind it. It has to recognize a loss, and to stay safe it pulls back on new lending everywhere else. A few troubled loans a bank can absorb. A wave of them, concentrated in a handful of lenders, is how a property slump quietly turns into a credit squeeze that reaches far beyond real estate, into small business loans, car loans, and hiring. That is the fear regulators keep circling back to. It is not that every office tower defaults. It is that the losses land unevenly, piling onto exactly the lenders least able to take the hit. So why has it not blown up already? Mostly because everyone involved has strong reasons to delay. Banks extend and pretend, granting short extensions rather than forcing a sale that would lock in a loss and expose it on their own balance sheet. Borrowers hang on, hoping rates fall before they are forced to act. And as long as a loan is merely extended rather than formally defaulted, the damage stays off the official books. That can work for a while. But every extension is a bet that conditions will improve, and each one just pushes the same unpaid balance further down the road, where the wall is still waiting. So the commercial real estate debt problem was never really solved. It was postponed. The core mismatch has not gone away. Too much debt taken out at low rates against buildings that are now worth less, all coming due at once, in a market where refinancing is far harder than the original loans ever assumed. What makes it so slow-moving is that nobody involved wants to be the one who triggers the reckoning. The bank does not want the loss, the borrower does not want to lose the building, and the regulator does not want to spark a panic. So the wall gets scaled one extension at a time, and the headline number barely moves, even as the pressure underneath keeps building. The maturity wall does not need a dramatic crash to matter. It just needs time to keep passing, one quiet extension at a time, until the bet that rates will fall in time finally runs out.